Alright, so this is part one. What accounting is and why it's awesome and potentially dangerous. Accounting as we know it today, the system that we use to keep track of businesses, transactions, and activities, was developed first in Tuscany, as part of Italy, back in the early 1300s. Now, Dr. Jacob Sowell, a professor of history and accounting at UC Davis, in his book The Reckoning, had this to say. The medieval Italian merchants did what the ancient Greeks, Persians, and Romans, the great Asian kingdoms, and the feudal lords could not. Without fanfare or public recognition, they invented double-entry bookkeeping, making the revolutionary leap into the calculation of profit. Although we do not know for sure who first did it, Tuscan merchants began developing double-entry bookkeeping. The records are of some debate, but the earliest recognized use of double entry appears in the documents and the ledgers of either the Ranieri Finney brother firm, 1296, which traded in fairs across Europe, or the Ferralfi Merchant House, 1299 to 1300, which traded between Florence and Providence. Now, we'll get into more of a discussion of what this double entry stuff means, but the reason I point this out is to highlight the fact that the processes we use today, even though we've migrated to technology and systems, we still have a foundation that dates back to the 1300s. Everything we do today still is essentially the same thing that was done in the 1300s, except we now do it with technology. So one of these guys, back in the early times in Italy, guy was named Francesco Datini, and he was from Prato, north of Florence. He became rich through trading with the Papal Court, the Vatican. And so an archive exists to this day of over 120,000 business letters and 500 some account books and ledgers that he kept for his business. And Dr. Sowell, in his book, says this: in minute detail, it reveals medieval Italian life, how complicated business was, and how keeping double-entry books required immense skill. His success came from acquiring investment capital through partnerships. He himself invested little of his own money, but was able to attract partners and investors. Only through expert accounting could this be done, for each arm of the business required not only basic accounting, but also the calculation at any moment of each partner's and investor's equity share of profits. So double entry came about. This process of doing accounting to find profit came about because you started to have companies develop that had multiple partners, multiple investors. And so to understand how much investment you had in a business, they needed a new kind of accounting. So that's where this came from. Now, this guy, his name was Luca Pacioli. It's a famous painting of him. He was a mathematician mostly, but he's also known as the father of accounting. And it's a little bit of a misperception because he didn't actually invent anything related to accounting, but he was the first person to document this system that the Italians had come up with to do accounting, to keep track of a business's activities. And so this dude, is known as the father of accounting. Now, he basically was the first person to write a textbook about how to do accounting in this way, in this new way that the Italians had created. Accounting had been around for a long time prior to this, prior to the Italians. But this new system, the system that they created, that we still use today in the western part of the world, he was the first one to document this. Now, again, I point all of that history out, not to bore you with history, because it's actually really exciting, but to show you that what we're going to learn in this class, right, people have been doing for a long, long, long time. Now, accounting is known as the language of business. It's kind of the nickname that people give accounting. Accounting is the language that we use to tell stories about companies in the business world. As storytellers, accountants possess the power to influence the thoughts and actions of others. As professionals, accountants must seek to use this power wisely and honestly. There are times where people do not use this power in a way that is honest. And we get into fraud, and we'll get into discussions of that kind of stuff later. Okay? But the way we tell stories about a company's success can influence the way people behave and the decisions that they make about whether to invest money of their own or not. And so accounting is a pretty big deal. And accountants have a lot of power, and they need to use that power wisely. Now, when attempting to learn a new language, you must first start with the basics, right? Of first importance is vocabulary. You have to learn what words mean. And so in accounting, vocabulary is essentially the elements. And through these videos, I'm going to be using a series of symbols just to remind everybody of the realm of discussion that we're talking about. And so we're going to use a symbol like this to highlight the fact that we're talking about elements here, okay, vocabulary. Second, once you know what words mean, you must study the grammar of the language, right? How to put words together to make sentences, right? So to make meaning. And so in accounting, we have something similar to grammar, and it's really what we call principles and assumptions, okay? And so we have two symbols here we're going to use to keep track of what we're talking about, whether we're talking about principles, assumptions, or elements, okay? So vocabulary, very important. What do things mean? And grammar, how do we put them together? Now, the elements, again, the things we are going to measure and report to other people. So the elements are the things that accountants have to keep track of, okay, and report to people, to put in a document and show to other people. The principles and assumptions are how those elements are going to be measured and reported. The vocab, which are the elements, and the grammar, the principles and assumptions of the language of business, are called generally accepted accounting principles. Now, these principles are usually referred to as GAAP, and today GAAP is determined or set by the Financial Accounting Standards Board, or what is most commonly called the FASB. Okay, so the FASB is a group. It's a private entity. It's a board that sets the rules for businesses in the United States. Okay. Now, when we start this discussion of the elements, the things that are going to be measured and reported to other people, we have to have a fundamental discussion, or we have to have an initial discussion of the accounting equation. Now, the accounting equation has to deal with three things. Number one, assets. The assets of a business are the resources that the business owns. So these could be things like cash, buildings, equipment. It could be things like the products that they try to sell to other people that we call inventory. Maybe it's just supplies. But the assets of the business are the resources that it owns. And those assets, the dollar value of those assets, is equal to its liabilities, the amounts it owes to others, and its equity, or stockholders' equity, the amounts invested and reinvested in the business by the owners. So, assets, the resources the business owns, are equal to the amounts it owes other people and the amounts invested and reinvested by the owners. So, the accounting equation is the foundation of everything that we're going to learn in this course. And it is the foundation of much of accounting in general. So, stockholders' equity has two pieces. The amount invested in the business by the owners. And this is what we typically refer to as common stock, because when an owner invests in a corporation, they receive stock in exchange. Stock, again, is just really the share of ownership that that person holds. So common stock refers to the amounts invested in the business by the owners. The second piece of equity is the amount reinvested in the business. Where does this reinvestment come from? Well, we call this reinvestment retained earnings. Now, we could simply rephrase that as kept profits. So, the profits get reinvested in the business, or retained. Now, where do the profits come from? Well, the profits come from a few different things here. Number one, the company has to have revenue. Revenue is the amount it charges customers for products or services. So if you go to the store, if you go to Target to buy some candy bars, and you go to the checkout line, the cashier is going to tell you, this is how much you need to pay. So the company is charging you for those products or services. That is revenue. Now, in order to do that, a company is going to incur costs. They have to have lights on. They have to pay their employees wages. They have to insure the products that they sell. Okay? They're also going to have heating and air conditioning bills and all sorts of other stuff. So those are expenses, the costs incurred so that a company can generate revenue. Now, the difference between the revenues and the expenses is the profit of the business. Now, the profits can be done, two things can be done with the profits. Number one, they can be reinvested. Number two, they can be given to the owners. And so the third thing to consider are dividends. Okay, dividends are the amounts that are paid to owners from the profits. So if you're an owner of a business, you may expect to get some payment from that business in the form of a return on your investment. And so dividends represent the amounts that are paid to owners from profits. So by taking the revenues, subtracting the expenses and the dividends, you get what we call retained earnings, kept profits. So for now, this is what the equation looks like in total. Okay, the basic equation is at the very top. Assets, liabilities, stockholders' equity. But equity has multiple pieces to it, and we need to understand that. Now, as you'll see, some of these account names are in black, and some of the account names are in pink. I did this for a reason. There are two kinds of accounts that we'll talk more about later. But the two kinds of accounts that we have are what are called permanent and temporary. Some accounts are permanent, some accounts are temporary. And we'll dive into that more later. Companies provide other people with information about the elements of their accounting equation by preparing financial statements. So a company is going to tell its bankers, its investors, its owners about the elements by putting them in financial statements. Now there are 4 financial statements that a company generally puts together. Number 1 is what we call an income statement. And the income statement is what tells other people about the company's profit. The second statement is called the retained earnings statement. And this statement describes how much of the profit has been kept by the owners and how much has been paid out of the company. The third statement is the balance sheet. And this shows the summarized accounting equation for a company. And the last statement is what we call a cash flow statement. And this shows where a company got its cash and where it spent its cash. Sometimes these statements have different names. Companies don't always use these same titles for their statements. As example here, sometimes the income statement is called the results of operations. Sometimes the balance sheet is called the financial position. And so it's okay if you see statements that don't have exactly the same names that we learn in this class. Title is a title. What actually happens in the statement, though, is going to be pretty much the same. Now again, you'll see here, some of these statements report information about permanent accounts, and some are going to primarily have information related to temporary accounts. Now, the income statement shows the revenue for a business, which is the amount it charges its customers for products or services. It's subtracting from revenues the expenses, the costs incurred to generate that revenue. You get what is called net income. And net income is the way we refer to profit in accounting. It's also sometimes referred to as the bottom line. The retained earnings statement starts with the retained earnings from the previous periods, so any profits that have been kept from prior periods. To those prior profits that have been kept, we're going to add net income, or the profit for the current time period. We subtract any dividends that are paid out to owners from the profits, those profits that are not kept, to determine how much profit has been kept from the previous periods and then including the current period. So that is the flow of the retained earnings statement. Now, once we've compiled or prepared an income statement and a retained earnings statement, we can build a balance sheet. So the balance sheet, again, shows the summarized accounting equation for a business. Therefore, it is going to report a company's assets, the resources owned by the business. It is going to report the company's liabilities, the amounts it owes to other people or other businesses. And it's going to report the company's stockholders' equity, the amounts invested and reinvested in the business by the owners. So, what are some assets? There are lots of different kinds of assets, and we're going to learn about a decent amount of them over the course of this class. But here are 7 common ones. Okay? Cash. Coins and currency that are on hand or in the bank. Accounts receivable represents the amounts customers owe the company. Inventory. These are the products the company sells to customers. Supplies are the products the company uses in its operations. Land, you're thinking things like real estate, upon which buildings really exist. Buildings, which are factories, office buildings, or stores. And equipment, computers, vehicles, furniture, machinery, whatever else relates that a company uses in its operation. Okay, so liabilities, likewise, there are a few that are pretty common. We'll talk about more as we go, but accounts payable is the amount company owes for goods or services it's purchased. Notes payable represents the amount a company owes because they have borrowed from a financial institution or a bank. Stockholders' equity, again, has 2 pieces. The amount invested in the business, which is represented by common stock, and the amount reinvested in the business, which is what we call retained earnings or kept profits. So when you build a balance sheet, we use it for a couple of reasons. We use a balance sheet to determine a company's solvency, or its ability to pay its debts. And we also use a balance sheet to determine a company's liquidity, how easily they can turn some of the assets they have into cash, because cash is the lifeblood of a company. So here are some examples. These are financial statements that are for our fictional company here, Carl's Canoes. And so the first statement, revenues, is listed on the income statement, $95,000, and then expenses are listed on the income statement. And generally, we try to list expenses from greatest to least, with income taxes at the bottom. And then we have net income here of $21,000, the bottom line. Retained earnings statement comes next. The beginning retained earnings for this company, I put in 0. What we do then is we add net income. So net income comes from our income statement, and we have $21,000 of net income, profit. We subtract the dividends, $1,500, and we get the ending retained earnings of $19,500. The balance sheet on the right side, they have cash, they have accounts receivable and supplies and equipment, and total assets then equal $37,400. Liabilities and stockholders' equity altogether add up to $37,400. Again, the balance sheet shows the summarized accounting equation for a business. Assets have to be equal to liabilities and stockholders' equity. So as we get into further videos, we will discuss how to prepare these statements and where these numbers come from and what they mean. Now, principles and assumptions to how to measure and report the elements. One of the things I want to talk about in this video is a principle. It's called the historical cost principle. This is a measurement principle in accounting that tells us that the dollar value of an asset on the balance sheet is based on its nominal or original cost when acquired by the company. So if I purchase a building for $100,000, my balance sheet will show a building for $100,000. If that building increases in value to $200,000, I don't really care. The historical cost principle tells me that my building needs to be recorded and reported on my balance sheet at what I paid for it. So that's one of the big principles that we follow in accounting. And as we get into future videos again, we will be dealing with this historical cost principle. My assets are recorded at historical cost. My liabilities are recorded how much I owe when I borrowed the money. Okay. Now, to summarize, accounting is a language, and languages are used for communication. What are companies communicating? Companies communicate specific details related to the elements of their accounting equation. This quote here comes from the FASB concept statement number 6, part of the generally accepted accounting principles we mentioned earlier. And it says the elements of financial statements are the building blocks with which financial statements are constructed. The classes of items that financial statements comprise. The items in financial statements represent in words and numbers certain entity resources, claims to those resources, and the effects. So again, when we're talking about the elements, we are talking about things like assets, liabilities, revenues, expenses, equity. How are companies communicating? So, what are they communicating? They're communicating about the elements of their financial statements. How are they communicating? Companies communicate effectively with each other about the elements because they follow generally accepted accounting principles, or GAAP, in the preparation of their financial statements. So they're going to be following these principles and assumptions. GAAP is set by the Financial Accounting Standards Board, or what we more frequently call the FASB. Now, why are companies communicating? So we know what they're communicating and we know how they're doing it, but why? They are communicating to provide financial information that is useful to investors and lenders in making investment or lending decisions. So if I am providing information to my investors, I am providing it so that they can make a decision about whether they want to continue their investment, increase their investment, or decrease their investment. And I'm going to provide it to external people, like lending institutions, so that they can determine if I'm going to pay them back, or if they should lend me money at all in the first place. So, that's the summary for the first video. And remember,